Hi there, it's Friday the 7th of February 2020. I'm Steve Towers. Welcome to ITB. Let's get started. As you know, on Wednesday and Thursday of last week, the Inclusive Framework held its latest meeting on the digitalisation project. And then all was revealed on Friday of last week in two ways. First, there was a 30-page statement released on the status of Pillar 1 and Pillar 2. And second, the OECD discussed the statement at some length in their latest Tax Talks webcast. For a copy of the statement and a replay of the Tax Talks webcast, please go to our website or app. You will remember that in October 2019, the OECD Secretariat drafted and released a public consultation document on the unified approach for Pillar 1. Well, the most important aspect of the statement, which was released by the Inclusive Framework last Friday, is that the unified approach is no longer an OECD Secretariat proposal. It has been adopted by the Inclusive Framework. And I would note, adopted with only a small number of changes. I'll focus on those in today's video. If you want to be reminded of the unified approach as described in the public consultation document, I suggest you re-watch ITB on the 11th of October. One of the significant changes is that the statement refers to the US Safe Harbor proposal, but without a conclusion. Many IF members express concerns that implementing Pillar 1 on a safe harbour basis could raise major difficulties, increase uncertainty, and fail to meet all of the policy objectives of the overall process. The IF members note that although the final decision on the matter will be taken only after the other elements of the consensus-based solution have been agreed upon, resolution of this issue is crucial to reaching consensus. The statement also notes some other significant divergences between IF members. IF members also recognise there are a number of other issues where significant divergences will have to be resolved. These include 1. The binding nature of dispute prevention and resolution mechanisms, as well as the scope of the dispute resolution mechanisms under Amount C. 2. The suggestion by some members to weight the quantum of Amount A to account for different degrees of digitalisation between in-scope business activities, so-called digital differentiation. And 3, the suggestion by some countries to account for regional factors in computing and allocating Amount A through regional segmentation. Members note that concerns have been expressed by some jurisdictions and businesses about the continued application of digital service taxes. However, in regard to DSTs, Annex 1 of the statement says this: it is expected that any consensus-based agreement must include a commitment by members of the Inclusive Framework to implement this agreement and at the same time to withdraw relevant unilateral actions. The statement tightens the description of the two types of business which will be in scope for Amount A. The first will be businesses that generate revenue from the provision of automated digital services that are provided on a standardized basis to a large population of customers or users across multiple jurisdictions, including revenue associated with the monetization of data. The statement provides this list of examples. Please hit the pause button to study the list. Further work will be required on businesses whose services might be delivered to a customer online but involve a high degree of human intervention and judgment. For example, professional services such as legal, accounting, architectural, engineering, and consulting, which do not fall within scope of this definition. The second business in scope will be businesses that generate revenue from the sale of goods and services of a type commonly sold to consumers, that is, individuals that are purchasing items for personal use and not for commercial or professional purposes. This would include businesses which sell consumer products indirectly to consumers through third-party resellers or intermediaries. Businesses which generate revenue from licensing rights over trademarked consumer products, and businesses which generate revenue from licensing a consumer brand and commercial know-how, such as under a franchise model. The statement provides this list of examples. Please hit the pause button to study the list. The statement identifies these out-of-scope businesses: sale of intermediate products and components that are incorporated into a finished product sold to consumers, with a possible exception: extractive industries and other producers and sellers of raw materials and commodities, most of the financial services sector, and airline and shipping businesses. The nexus rule in regard to a particular jurisdiction will be different for automated digital services and consumer-facing businesses. For automated digital services, there will be only one test: the amount of revenue derived from the jurisdiction. For consumer-facing businesses, there will be two tests: the amount of revenue derived from the jurisdiction plus factors which indicate a sustained interaction with the jurisdiction. For example, physical presence in the jurisdiction or targeted advertising directed at the jurisdiction. In regard to the revenue test, clear, easy-to-administer source rules will be required in the final design. In regard to the quantum of amount A, the statement favours the use of profit before tax, as shown in the consolidated group financial accounts, as the tax base. Also, there will be loss carry-forward rules. And in regard to the allocation key, the statement says this: the allocation key will be based on sales of a type that generate nexus. Specific revenue sourcing rules to support its application by reference to different business models will need to be developed. For example, for online advertising, such rules will, when possible, deem revenue to arise in the jurisdiction where the advertising is viewed, rather than the jurisdiction, if different, where the advertising is purchased. Revenue sourcing will also be considered to address sales through independent distributors in order to avoid possible distortions. The statement envisages an innovative process to avoid disputes in regard to amount A. The process should provide early certainty before tax assessments are made to avoid disputes from arising. Certainty should be available over all aspects of amount A, such as whether an MNE is in scope, the correct delineation of business lines, allocation of central costs and tax losses to business lines, whether a nexus exists in a particular jurisdiction, and identification of the relieving jurisdictions for purposes of eliminating double taxation. It is agreed to explore an innovative approach under which tax administrations of the IF would provide early tax certainty for Amount A, for instance through the establishment of representative panels which would carry on a review function and provide tax certainty. This would require work on the process and governance of such panels to ensure appropriate representation of members and effective, transparent and inclusive processes. And finally, in regard to Pillar 1, the statement envisages a new multilateral convention. Implementing the new approach will require changes to domestic legislation and to tax treaties to remove existing treaty barriers. If different approaches could be envisaged to streamline the implementation of these changes, a new multilateral convention could be negotiated to establish a new multilateral framework for in-scope MNEs to ensure that all jurisdictions can implement the unified approach consistently and at substantially the same time. Unlike the multilateral instrument used to implement some BEPS measures, a new multilateral convention would apply between jurisdictions that do not currently have a bilateral treaty, supersede the relevant provisions of existing treaties concluded to eliminate double taxation, and contain all the international rules needed to implement the unified approach: scope, nexus, profit allocation, elimination of double taxation, and dispute resolution that are central to achieving tax certainty. This approach would better facilitate the coordinated, consistent, and effective implementation that is necessary between multiple jurisdictions and would close the gaps in treaty coverage. The application of the different elements of the package, amounts A, B, and C, in relation to jurisdictions that are not currently covered by a relevant bilateral tax treaty, and the required commitment by non-treaty jurisdictions are issues that will need to be further explored. You'll remember that in November 2019, the OECD released a public consultation document on the Globe proposal in Pillar 2. And that document was full of issues which the inclusive framework has identified to study. Well, there's nothing new on Pillar 2 in the statement. The issues are still there, and we're told that the inclusive framework is studying them. For a reminder of that public consultation document, I suggest you rewatch ITB on the 15th of November. In fact, the only interesting comment on Pillar 2 which I found in the statement is this: the actual minimum tax rate to be applied under the Globe proposal has not yet been discussed by the inclusive framework. According to the statement and the Tax Talks webcast, an ambitious schedule is planned for the rest of 2020. And note the importance of the next IF meeting on the 1st and 2nd of July, where it is planned there will be agreement on the key policy features of a solution. And the OECD has scheduled another Tax Talks webcast for next Thursday on the topic of the economic analysis and impact assessment of Pillars 1 and 2. To register for the webcast, please go to our website or app. In Turkey, the tax authorities have released for public comment draft guidance on the country's 7.5% DST. For a copy of the draft guidance, please go to our website or app. And in the UK, Netflix has been accused by Margaret Hodge, a prominent Labour Member of Parliament, of superhighway robbery in regard to its UK tax affairs. and a civil society group, TaxWatch UK, has released a critical report on the topic. Both of these items are relevant to the upcoming parliamentary debate on the UK's proposed DST. For a copy of the TaxWatch UK report, please go to our website or app. The OECD has announced that next Tuesday it will release the final version of its long-awaited chapter on financial transactions for inclusion in its transfer pricing guidelines. You'll remember that we last heard about this topic when the OECD released a non-consensus discussion draft in mid-2018. The OECD has released a public consultation document which reviews the system of country-by-country reporting under BEPS Action 13. Public comments are requested by the 6th of March, and a public consultation meeting has been scheduled for Paris on St. Patrick's Day. For a copy of the public consultation document, please go to our website or app. In Hong Kong, the government has released a draft bill which will provide tax concessions for ship leasing. Under the bill, a 0% profits tax rate will apply to qualifying ship lessors, and an 8.25% profits tax rate will generally apply to qualifying ship leasing managers. The bill also includes some substantial activity requirements which the government hopes will be acceptable under BEPS Action 5. The bill is planned to be introduced into the Legislative Council next Wednesday and will be effective from the 1st of April. For a copy of the bill and its explanatory notes, please go to our website or app. In India, the government has presented its 2020 budget. There are quite a few international tax changes. I'll run through the major changes now. Unless stated otherwise, all changes will apply from the 1st of April 2020. Dividend distribution tax, which is currently imposed at an effective rate of 20.56% on dividends paid by Indian companies, will be abolished. It will be replaced by a 20% dividend withholding tax, the rate of which will be limited under double tax treaties. Most of India's treaties limit the rate to 10%, but the rate for the US is 15% and the rate for Mauritius is 5%. The existing significant economic presence provisions, which were introduced in 2018 but have not yet become effective, will be deferred to the 1st of April 2021 in light of the ongoing inclusive framework discussions on Pillar 1. And speaking of Pillar 1, the source rules will be expanded to deem an Indian source for revenue arising from advertisements which are targeted at Indian customers, the sale of data collected from India, and the sale of goods and services using data collected from India. However, this should only be relevant to non-residents which cannot claim exemption under treaties. There are some changes to interest withholding tax on outbound interest payments. Firstly, the existing concessional rate of 5% is extended to qualifying loans and bonds issued on or before the 30th of June 2023. And secondly, a new concessional rate of 4% will apply to qualifying bonds issued on or before the 30th of June 2023, provided that they are listed on a recognised stock exchange. The domestic law definition of royalties will be expanded to include income from the sale, distribution, or exhibition of films. In regard to transfer pricing, the scope of the APA and Safe Harbour programs will be expanded to cover the attribution of profits to PEs. Under current law, non-residents are exempted from filing income tax returns if they derive only interest or dividend income, provided that withholding tax at the domestic law rate has been deducted. This exemption will be expanded to royalties and fees for technical services, provided again that withholding tax at the domestic law rate has been deducted. Resident and non-resident e-commerce operators will be required to withhold tax at 1% on the gross amount of payments made to Indian resident participants for sales of goods or services facilitated through the operator's platform. And finally, two changes in regard to funds. Firstly, in regard to the indirect transfer rules, the exemption for so-called Category 2 funds will not be available for such funds which are registered under the 2019 regulations. However, the exemption will continue for such funds registered under the 2014 regulations. And secondly, the existing conditions for the no PE safe harbour provisions for offshore funds will be relaxed. For a copy of the budget speech and the finance bill as introduced into Parliament, please go to our website or app. Indonesia has signed a new double tax treaty with Singapore, which is significant as Singapore is a popular holding company location for Indonesian subsidiaries. And that popularity exists despite the fact that the existing treaty does not provide any exemption or limitation of Indonesia's capital gains tax on sales of shares in Indonesian companies. Well, the new treaty contains a capital gains article, which will exempt capital gains on sales of shares in non-land-rich Indonesian subsidiaries which are not traded on the Indonesia Stock Exchange. The Brexit transition period runs from the 1st of February to the 31st of December 2020. There is some possibility for the two sides to agree to extend the transition period. During the transition period, as agreed in the withdrawal agreement, the EU's VAT and customs duty regimes, the EU's tax directives, and the judicial authority of the EU courts will all continue to apply to the UK. Also, during the transition period, both the EU and the UK want the UK to continue to be treated as an EU member state under the EU's international agreements with third countries, for example, free trade agreements. The EU has notified third countries of this, but the decision on this point lies with the third countries. The UK government has released guidance on this issue. For a copy of the guidance, please go to our website or app. In regard to the negotiation of the long-term relationship between the EU and the UK, the European Commission has taken the first step, which is to secure approval from the 27 member states for a mandate for the Commission to open negotiations. The Commission has released the draft text of the mandate. For a copy, please go to our website or app. It's expected that the negotiation will commence in early March. But both sides have already started the public relations battle. The EU's Michel Barnier said this week, "We have already agreed with Prime Minister Johnson that our future partnership will prevent unfair competitive advantages. That means mechanisms to uphold the high standards we have on social, environmental, climate, tax and state aid matters today and in their future developments." To which Boris Johnson replied, There is no need for a free trade agreement to involve accepting EU rules on competition policy, subsidies, social protection, the environment, or anything similar any more than the EU should be obliged to accept UK rules. I've previously discussed the potential impact of Brexit on benefits under US double tax treaties. But now that Brexit has arrived, it's worth emphasising the point. The issue is how to satisfy the derivative benefits test under the LOB article in 16 in-force US treaties. In all of those treaties, a qualifying owner is defined as a person which is a resident of an EU member state or of a country which is a party to the NAFTA. For example, assume that a UK company is the parent company of a group. The shares in the UK parent are publicly traded. The UK parent owns 100% of the shares in a subsidiary in Luxembourg, and the Luxembourg company has made an interest-bearing loan to a US group company. If the interest were paid by the US company direct to the UK parent, the interest would generally qualify for 0% US withholding tax under the UK-US treaty. Because of that position, Luxco might satisfy the derivative benefits test under the LOB article of the Luxembourg-US treaty, based on the fact that it is 100% owned by the UK parent, provided the UK parent is a resident of an EU member state and a base erosion test is satisfied. Now that the UK is not an EU member state, Luxco might not qualify for benefits under the Luxembourg-US treaty. There currently is no clarity as to how the transition period impacts this situation. There is, of course, the possibility of discretionary relief being granted by the US competent authority, but that is time-consuming and not guaranteed of success. A similar issue will arise when the USMCA replaces NAFTA, which is expected to occur in the next few months. The European Court of Justice has decided a case in regard to Belgium's stock exchange tax. The case concerns the freedom to provide services under Article 56 of the Treaty on the Functioning of the European Union. The stock exchange tax is levied on various investment transactions which are executed or which are deemed to be executed in Belgium. It's levied in two situations. In situation one, the transaction is executed by a Belgian professional intermediary, which is acting on behalf of a Belgian resident investor. In situation one, the tax is levied on the Belgian professional intermediary and no administrative burden is placed on the Belgian resident investor. In situation two, the transaction is executed by a foreign professional intermediary, which is acting on behalf of a Belgian resident investor. As Belgium cannot enforce Belgian tax obligations against the foreign intermediary, in situation two, the tax is levied on the Belgian resident investor, which therefore has various administrative burdens. In this case, the taxpayer argued that situation two discourages Belgian resident investors from using foreign intermediaries because it places administrative burdens on the Belgian resident investors. And, said the taxpayer, that means that situation two breaches the freedom to provide services. The court agreed that the two situations are comparable and that situation two places administrative burdens on the Belgian resident investor, which does not have those burdens in situation one. However, the court concluded that that difference is justified in order to ensure fiscal supervision, facilitate collection of the tax, and combat tax evasion. It therefore held that there was no breach of Article 56. Quite a number of EU member states have not met deadlines to fully transpose various directives into national law. The European Commission has sent formal notices to all of them. A formal notice is the first level of infringement procedures. The Commission has also published the 2020 edition of its annual report, Tax Policies in the European Union. For a copy of the report, please go to our website or app. You will remember that in December 2019, Germany put forward a proposed design for the EU's financial transaction tax, which is being pursued by a group of 10 member states. Well, Austria, which is one of those 10, has publicly rejected Germany's proposed design. According to Chancellor Kurz, the Austrian government wants the financial transaction tax to be a tax against speculation and not to have a broader application. In France, the tax authorities have issued guidance on the application of the new statutory provisions on abuse of law. The new provisions use a principal purpose test, which is derived from the General Anti-Abuse Rule in Article 6 of the EU's ATAD 1. For a copy of the guidance, please go to our website or app. Also in France, the Supreme Administrative Court has decided a series of 3 cases concerning the taxation of French real estate investments made directly or indirectly via French partnerships by the Kuwait government. The 3 cases concern the taxation of rental income and capital gains on the sale of immovable property. For a copy of the 3 cases, please go to our website or app. In Greece, the tax authorities have issued guidance on the reduction in the rate of dividend withholding tax from 10% to 5%, which was effective on the 1st of January 2020. For a copy of the guidance, please go to our website or app. In Russia, the First Court of Appeal has decided a case in regard to the beneficial ownership condition in the dividends article, Article 10, in the Cyprus-Russia Treaty. A Cyprus company owned shares in a Russian company. Those shares were the only assets of the Cyprus company. The Russian company paid dividends to the Cyprus company. The Russian domestic law dividend withholding tax rate is 15%. Under Article 10 of the Cyprus-Russia Treaty, that withholding tax rate is limited to 5%, provided the Cyprus company is the beneficial owner of the dividends. The Cyprus company used the cash from the dividends to pay its own dividends and to pay interest to related companies in BVI. The Russian tax authorities took the view that the Cyprus company was not the beneficial owner of the dividends because the shares in the Russian company were its only asset. The dividends from the Russian company were its only income, and the cash was subsequently paid by the Cyprus company in the form of dividends and interest to the related companies in BVI. And the court agreed with the tax authorities. In Sweden, the Supreme Administrative Court has decided a case in regard to the refund of VAT input tax in the situation where services are provided to a customer in another EU member state. A Swedish company paid Swedish VAT in acquiring services from Swedish suppliers. The Swedish company provided its own services to a Luxembourg company. Those services were exempt from VAT in Luxembourg. The issue in the case was whether the Swedish company was entitled to a refund of the Swedish VAT input tax. Sweden's VAT law sets out 2 conditions for such a refund, both of which must be satisfied. First, the service would be taxable if it were supplied to a Swedish customer. And second, the service is taxable in Luxembourg. The first condition was satisfied in this case, but the second condition was not. The Swedish company argued that the second condition breaches the EU's VAT directive. However, the court held that it does not. And so, with only one of the conditions satisfied, the Swedish company was not entitled to the VAT refund. For a copy of this case, please go to our website or app. In Botswana, the government has presented its 2020 budget. Only one item caught my eye. Incentives for export-oriented businesses will be introduced. The incentives include a 5% corporate income tax rate for the first 10 years and a 10% rate thereafter. Cameroon has extended its VAT law to apply to non-resident digital service providers, both B2C and B2B, including non-resident operators of digital platforms which facilitate the supply of goods or electronic services. The new provisions are effective from the 1st of January 2020. And now for this week's treaty developments. We've had one treaty signed, one treaty enter into force, and one protocol enter into force. I have two articles for you this week. The first article is called The ATAD CFC, All Roads Lead to Cadbury-Schweppes. It's written by Francisco Alvarez and it's published in the CLUA International Tax blog. This article considers the CFC rules in the EU's Anti-Tax Avoidance Directive. In particular, it focuses on whether the second alternative way in Article 7.2b of calculating the CFC income is subject to the wholly artificial arrangement limitation derived from the ECJ's decision in Cadbury-Schweppes. As you might know, the first alternative way in Article 7.2a for the calculation of the CFC income expressly includes that limitation. The author concludes that both alternatives are subject to the Cadbury-Schweppes limitation. The common effect of Article 7.2a and b is that the EU1 resident parent will be taxed on some or all of the income earned by its EU2 resident subsidiary, whilst in a purely domestic transaction, the EU1 resident parent will not be taxed on the income earned by its EU1 resident subsidiary. Thus, the proposition that CFC rules are inherently restrictive of the fundamental EU freedoms, particularly establishment, remains true, regardless of how CFC income is defined. There remains a restriction on the fundamental EU freedoms, and that restriction is justified only if the national measure specifically targets wholly artificial arrangements. And the second article is called Taxation of Offshore Indirect Transfers in Brazil in Need of Reform. It's written by Laura Kurth and it's published in the IBFD's Bulletin for International Taxation. An interesting aspect of this article is that the author provides a comparison between Brazil's approach in taxing offshore indirect transfers, which is based on anti-abuse rules, with the corresponding approaches taken in India, China, Australia, and Chile. The author writes this. This article identifies at least 3 different approaches used for instituting OIT rules. 1. An objective approach, under which bright line tests determine when an OIT of assets should be considered to have taken place, as applied by Australia and India, but with significant differences in terms of scope. 2. A subjective approach, where such a determination relies on the power of the tax authorities to act on the basis of anti-abuse rules, as adopted by China. And 3, a hybrid approach, which combines bright line tests and specific anti-avoidance rules to determine the OIT taxability, as applied by Chile. Well, that's the way it is this Friday, the 7th of February 2020. I'm Steve Towers. Have a great weekend.